Cool. All right. So thanks everybody for joining the multifamily market update. I know that we just had a meetup a couple weeks ago, but I wanted to give you guys a quick update on the market before we all disappear for the holidays and into the Thanksgiving season. I think the current plan is we'll probably do just another quick meetup during December and then take a break, enjoy the holidays and everything. And then we'll pick things, really back up once we get started in 2022. Okay. So today we're going to be talking about like what we're seeing in the multifamily market and as well as other investments. So just a general update. I kind of like to do this every once a quarter or every half a year, just to kind of see where the things are, right? As always, us as investors, we should always be looking at different markets, different investment types. Multifamily has always been good, but it may not always be the best thing as well. So, open our eyes and see, what actually fits our profile. So this is what this meeting is designed for too. So quick disclaimer, we're not brokers, agents, or attorneys, no legal advice. What we discuss here is only for educational purpose. We're not trying to sell anything, okay? I'm gonna add an additional disclaimer. I'm not an economist either, but there's some really good research done by large brokerages around the country. In today's session, I'll actually be using a lot from a company called Newmark. They do excellent research. So I'll pick the interesting pieces out of it and talk you guys through, and hope everybody can help to understand like what we're actually seeing. Okay. So if you're interested in what we talk about, and if we're always working on deals, we're always looking to acquire more assets. So if you're interested in being notified when we have a deal coming up available, please do join our mailing list. Okay, the link is below. I'll also send it out real quick in the chat, and you feel free to sign up while you listen. So here you go. Bit.ly. That's the best way to get in touch with us. Okay. Cool. So upcoming events, like I mentioned, we're probably going to do Apartments 104 sometime in December. A brief talk about lending. We'll also cover that a little bit today, but we'll cover in more length during that time. So in terms of like, and the next year, we'll actually dive down more into like the daily operations of things. So, how to manage properties when you have 100, 200, 400 units and multiple of these apartments, right? How do you manage it at a larger scale? We'll also talk about like the most exciting thing, right? When you actually sell a property, or how do you cash out? How do you refinance money out of the deal and use that to invest in even more assets, right? So, okay. Next year, I'll also talk about something that, a lot of us here are actually very interested in. How did I go from a techie to single family and then jumping right into multifamily? What was my journey? What enabled me to make this transition? So that should be pretty interesting. And finally, we'll talk about, so we currently have an asset that is under contract to sell. I'll do a case study on this, the sale of this 146 unit assets in Dallas. So from beginning to end, all the pains that we went through, all the gains, and how did everything work out, right? So I think it's a great experience to see what actually happens during a transaction. Okay. Quick agenda for today. I'll try to keep it short. So Link from a little bit about us. We are Link Multifamily, and we'll start diving right into what is currently driving the market, right? Where's the money coming from, the rent trend, etc. We'll talk about what we've been seeing in terms of like the multifamily pricing, okay, in Dallas and other areas. And then finally, we'll talk about some of the recent changes in loans. So what are we seeing in terms of options for different type of loans? Okay. So a little bit about us. So we're Link Multifamily. We are a team of investors based mostly out of California, but still have people across the country as well. So we like to invest in not in California. We live here, we love living here, but we like to invest outside of California. So so far we have acquired over $35 million worth of assets, about 250 units, and we raised over $6 million in funding. So anytime that you see a hotel or apartment being built, being acquired, none of these is never one person going to buy a whole deal, right? Nobody can come up with 300 million. It's always with a group of people, going to acquire it together. And this allows like ordinary people like us to be able to scale up and acquire institutional size properties by doing it together. All right, so okay, so right now, I'm actually happy to see that this meetup has grown to over 1,000 members. I mean, that's incredible, I think. So very happy to have everybody here, and I'll do what I can to share valuable content. Okay, so a little bit about me. My background is in software, so and I love working in small startups. So I was fortunate enough to be in 2 IPOs in the past 20 years. So with that, I made a lot of investments in real estate overseas. But locally, I also invested in a lot of syndication deals. So I have invested in apartments, also self-storage, new construction, basically commercial services. And I personally, try out many different things, right, to see what works and what doesn't. So right now I have investments in Texas, in Arizona, in Wisconsin, Indiana, and probably very soon I'll also be having investments in Kentucky as well. So, I'm not focused on just one state. We're starting to branch out. So wherever there's a good opportunity and I think the deal looks good, I will invest in it. But majority of my investments is in apartments. So I'm investing over 4,000 units right now. And I'm actively managing three I'm actively partnered in 3 deals myself, right? So in addition to the 2 that I currently actively manage, also partnered in another deal, 210 units. So for a total of 580 units. Yeah. So, and we have a successful exit in one of our deals right now. Okay. A little bit about my partner, Aziz. Aziz is a tech executive in the Silicon Valley. He brings a whole wealth of knowledge in terms of like operations and the ability to pick the right investments, right? So Aziz is great in that. So Aziz also has been investing in many different things like oil and gas, hotels, and multifamily as well. So. All right. So very quick, we invest in apartments, right? And apartments are really broken up into different categories according to their age, right? So class A is basically your 20 years old or younger properties, okay? And then class B is your garden style, 2 to 3 stories with these kind of pitch roof, okay? These are usually built in the 1980s or so. And then there's also Class C, which is basically 1960s and maybe some 1950s build, right? So you notice that each of them actually have a very different look, right? Every 20 years or so, the styling changes. And so we primarily invest in the Class B space, the workforce housing. But at the same time, we're also looking at some Class A assets because right now their pricing is so close. So it actually makes sense to pick up some newer properties. And one of our game plan is to hold them on for a longer period of time. There's they cost more, but there's less maintenance to go with it. So, all right. So the general plan when we go for a Class B unit is we would renovate the interior. We do what's called a light renovation. So we would basically take a classic unit like this and renovate it to a level like this, right? So this is basically a $3,000 renovation per unit. Very, so it's light reno. We're not tearing down walls. We're not replacing cabinets. All we're doing is just painting cabinets, installing granite, installing appliances, right? So when we do things at scale, we get prices that are much, much cheaper, sometimes 50 to 60% cheaper because we're buying a couple hundred at a time. And yeah, the economy of scale really plays in when you even have additional multiple apartments, right, that you're managing, and you're really able to source materials at bulk prices. So for a renovation like this, we can usually charge anywhere from like $75 to $100 extra in rent. And that allows us to drive up the value of our business. And therefore we can sell the apartments for a lot more. Cool. So yeah, we're very excited that one of our first deals, the Class C property, this is located in Dallas-Fort Worth, in a city called Arlington. So we had it for about 3 years. We bought it for about 11.7 million. And right now we're under contract to sell for over 17.3 million. And that's only in 3 years. So it's been really great. It cash flow really well. So we were able to go in there and renovate the units. So yeah, in the future, I'll do a case study on this, but we're probably expecting to close, close on this sale beginning of next year. So yeah, things are going well. Cool. So now we get to the meat of today's presentation. So how is the current market going? So before we start diving into this, I just want to check if anybody have any questions or any comments before we get started. Okay, cool. All right, let's go ahead and get started. So we're in the COVID economy, or rather the post-COVID economy. And so one thing, if you guys remember, if you guys were in part of my previous presentations, I was showing basically our prediction of what the job recovery might look like. Okay, so at first we thought that it would probably look more like a square root function. Okay, so it would go up, down, and then just flatten out over here. Okay, so we're actually very pleasantly surprised to see that the unemployment rate has actually recovered much faster than expected. So compared to previous recessions, this recovery period only took about a year and a half, right? So, which is actually pretty fast compared to previous downturns. So, this really was semi-temporary anyway. So it was really good to see the job markets recovering so fast. I think we still have a lot of people sitting on the sidelines, taking in government checks, but that's starting to go away, and people are going to have to start coming back into the workforce. But right now, one thing we do see across the board, I'm sure you hear business owners complaining about it, is it is just so hard to find people. There's a severe labor shortage, right? There's a few reasons for that, because people basically during this time where the government is paying you to sit at home, they're also taking this opportunity to think about, like, do I want to continue to work as a restaurant worker? Do I want to continue to work in Walmart, right? Should I take this opportunity to go for a better paying career? Okay, so a lot of people have made that transition or is training themselves to make this transition. And then this labor market just kind of exasperates itself, right? So now that there's no labor, everybody's fighting for people, right? Amazon increased their hourly rate to, I mean, San Francisco, I would say a couple of years ago, we were shocked that they were moving the minimum wage to like $15 an hour, right? McDonald's paying $15 an hour. That's nothing now. Amazon, just raised their minimum hourly rate from to 18 and even $20 an hour, okay, for unskilled labor, right? I think in a social function I went to over the weekend, basically one person quit their restaurant job, and then it's like the boss asked him, like, why are you quitting? So he said, well, I'm gonna go work for this golf course. And they're trying to hire people to work for the golf course, and they're paying $36 an hour, right? So, how do you compete with that? So, we definitely see a severe labor shortage that's causing payroll to increase significantly. Okay, so that's something to really factor in. We're going to talk about inflation later, but I think there's a real concern for a more longer term inflation than I don't think it's temporary. So for example, like these salaries, right, or these hourly workers, once their minimum wage has gone from 10 to 15, and now it is like 18 or $20, right? Wages tend to be very sticky. Once it gets up there, once people are used to getting paid $18, $20, it's not likely that it's going to drop down to $10, right? Wages tend to be sticky. So, which means that, we're kind of looking at a new norm of income for the middle class, right? So what this means is, for restaurants and other businesses to compensate, they're probably not going to be able to wait around for a time that the wages actually drop, which means that they need to increase the prices of the goods that they're offering, right? So you're probably going to see higher food prices. You're going to see higher, higher prices for products and services, and that's just going to, so I think inflation is going to have a permanent effect. We're probably not going to go back to the original pricing, right? Lunches right now is $14, $15. People are still paying it. People are used to it. It's not going to go back to the $8 that we had before. So, yeah. So, now that we can see that inflation is going to be on the horizon, okay, then where do you put your money? Okay, so most of the time, the logical thing to do is when you see inflation coming down the horizon, you want to be in real estate. Okay, you want to be invested in some kind of asset that adjusts itself to the inflation rate, right? So if you take a look, for the past 10 years or so, our inflation has actually been relatively tame, hovering right around 2%, 3% or so. And then we saw a massive run up in over summer to now, right? I mean, we're looking at 6% or even higher inflation, and that has caused the Fed to start take action, okay, to slow their rate of buying treasury, so that they're not propping up and making the inflation worse, right? Then you want to be an asset, right, that will go up. If people's ability to pay goes up, then you want to be an asset class that can take advantage of that. So which is why asset class such as apartments do really well, right? So if you invest in an apartment, as people wages rise, it's natural that the rent will naturally rise with the inflation. So that's a nice thing, right? It just automatically, it's a hedge against inflation. So yeah, so that's part of the reason why there's so much activity into buying single family homes, or so much activity into buying multifamily assets as well, because it serves as a really good, counterbalance and, real benefits when you see inflation coming. Okay. So I think as a result of the inflation rising, the Fed is going to stop trying to prop up our economy. We're in pretty good shape, actually. So the Fed is currently starting to slow down the rate at which they buy the 10-year Treasury. And the way that the inflation is going, I think early next year, they're just going to stop buying it altogether. Okay. So we do expect that the Treasury rate to start going up. So you'll probably hear a lot of people saying that, hey, interest rate is going up, interest rate is going up, right? Yes, interest rate is going up, but if you look at the historical trend, the historical trends shows us that, well, in general, actually, the Treasury rate is trending down. It's been decreasing through all these years. So the lending cost is actually very affordable nowadays. So, even if the rates rise a little bit, we're still at historically low rates, right? I mean, you have home mortgages that are going for like 2.5% or 2.7%. So even if it rises a little bit, it's still extremely attractive, and it really enables people to buy and afford assets and investments. Okay. So like I was saying, during high inflation periods, then people like to invest in real estate as a hedge, right? And it usually it benefits tremendously as well when inflation goes up, disproportionately increases, right? So if you kind of take a look at it, with the core, here is the core inflation rate in the circle. And this is basically the average return of real estate over these past years. So you'll see that, in 2021, right now we're kind of expecting the returns to be about in the 10 to 12% range, still far exceeding, where the inflation is going, right? So while you see the inflation is coming up, the worst thing you can do is keep your money in the bank and not have it working for you, because you're literally losing 5 to 6% to the inflation. Your money is losing value, right? I would say the minimum of which is you should put it into some I-bond or something that's indexed to inflation so that you're not losing money, right? So, but real estate investment tend to do really well during this time. Okay. So as investors, we typically try to see like what is a good time to invest, right? So here is basically the 10-year Treasury trend, okay, versus the multifamily cap rate. So think of cap rate as kind of what you kind of expect to get in return, okay, in annual return in terms of like cash on cash return. Not exactly, but it's a rough indication of what kind of returns you can get. Okay, so while the cap rates have been decreasing, okay, you see that we still have a very wide gap versus the Treasury. Okay, so the times that when you find that it is not worthwhile to invest in multifamily, for example, will be like around here. Okay, So here you can see that, well, the treasury is paying out about 5%. And then if you invest in a multifamily property, you can expect to get about, 5.8%, cash flow. Then it doesn't really make sense, right? I can buy something that is much more secured, much more less risk. I can buy a 10-year treasury for almost the same return as a multifamily, right? So during this time, people would not be investing in real estate or multifamily. They can just buy they can just buy CDs, they can just buy 10-year treasury and get almost the same amount of return with much lower risk, right? However, when this yield spread is so much larger, like right now, if you take a look at it, it is still about investments in real assets is paying at least over 3% over what you can get with a 10-year treasury. This period is when you actually see money flooding into real estate and multifamily. Okay, it's because you can get such better return compared to just putting into something safe. Okay, and like I said, this cap rate is a general general guideline trend that we talk about, but it doesn't represent the actual return of actual multifamily investments, right? Nowadays, I would say in terms of like multifamily investments, the annual return is closer to, I would say, 12 to 15% annual. Okay, this just kind of represents the cash on cash portion of that. So if you guys have any questions, just feel free to pop them into the chat and then I'll answer them along the way. All right. So, what have been, what have people been, so when we talk about commercial real estate, right, we're mainly talking about a few categories. We're talking about, like, for example, investments in offices, investments in retail stores, multifamily, hospitality, which is like hotels and restaurants, all that kind of stuff, right? And then, also industrial, all this kind of different commercial type of assets, right? So, it's very important to look at how did they do during a downturn, okay? One of the reasons why I picked multifamily as my main investments is because I know that during a downturn, people will give up their car, people would give up luxury items, they would stop traveling, they would stop eating out, but they always need a place to live, right? That's one thing that they don't want to lose during a downturn. So multifamily historically has done really well during downturns. And that's why, I like stability. I want investments that will not lose my principal when the economy is bad. I don't want to have to feed it more money. Okay, so and I was very glad to see this is reaffirmed during this downturn. So you'll see that in terms of like the return seen during offices, it has been pretty low, right? There's less people returning to work. The leases hasn't been extremely high, but the people who lease offices tend to sign a longer lease, like 5 years, 10 years. So you won't see like an immediate drop in returns because those people are still paying. Larger companies still have money to pay for the leases, but they're actively trying to sublease it out. Okay. So as you see the leases expire and then they don't renew because they're scaled down or something, these returns might actually drop even lower. And I think retail, we all know that retail has been extremely challenging during this period of time, starting to climb back up, okay, but starting to stabilize. But retail is kind of like a boom or bust kind of business, right? So when economy is good, retail does really well, but when the economy is not good, then they suffer as almost right away. Okay. Multifamily has been kind of a safe haven. You'll see that the returns have dropped during the COVID times. So each one of these represent a year. Okay. So, and this is mainly because during COVID, none of us were trying to raise rent. We were just trying to stabilize. We were trying to make sure that our occupancy stayed full. Okay. But this year, whatever we didn't raise rent the previous year, it's all coming back this year. You're seeing a lot of gains on the multifamily side. So it did really well. It held up during COVID, and it's roaring out of the gate now that we're back. Okay. Hospitality, as you can see in 2020, nobody traveled, so hotels did really bad. Starting to recover a little bit now, but still very, very challenging. Okay. And from this, you can kind of see why people are starting to invest into multifamily. And it's not just the typical people who buy multifamily. It is people who traditionally have been investing in office, in retail, or hotels. They got burned, and they all now want to invest in something that looks really safe during downturn and has really good returns still, right? So that's what we're seeing. We're seeing a lot of capital coming from these different commercial asset classes, all converging into multifamily, and that's really driving a lot of the price increases that we have seen so far. And this is not a short-term thing. I think people realizes the characteristics of multifamily, and it's going to continue to drive more and more investments into multifamily. Okay. Yeah, so Edison was asking what are each column. So this is actually 2019, 2018, 2019, 2020, and 2021. So you can kind of see how it's been trending. Okay. So why are people looking, at multifamily and other asset classes? Well, then, we want to see what did bad during the downturn, right? So the CMBS is basically loans, and these are the number of people that have, the number of businesses that have defaulted on their loans, okay, by property type. So you'll see that hospitality had the highest because they were almost like 90% empty, right? During 2020, there were a lot of defaults. They're stabilizing, but it's still not great. Okay. Hotels operators have lost a lot of money. Okay. Similarly for retail, a lot of retail businesses wasn't able to hang on, and they have filed for bankruptcy and defaulted on their loans, right? Whereas multifamily, the default rate is like extremely low. It's like less than 3%, compared to, it's been holding pretty steady at less than 3%, compared to 24% for like hospitality, right? Office, because like I mentioned, these tend to be large tenants that can pay, and they pay for multi-year leases, right? So it's been stable. Industrial has been doing really good during this time. People have been staying at home and ordering from Amazon, like literally nonstop. They don't want to go to a store because they don't want to be infected. So now you need all these places to store all these products to be shipped out, right? And you see the log jam that we have at Los Angeles and other places. So with more and more online shopping, the needs for warehouses and other industrial plazas, right, is increasing. So like Port of LA is just completely stuck, right? You have all these containers. What are you going to do with them? They want industrial parks or these places to put the goods, right? So there's very large demand for industrial right now. And then in terms of like, by large metros, right? Who's been having the most amount of defaults? New York has been doing really bad, unfortunately. I think out of all the multifamily markets, I think New York is the one that hasn't really recovered. The real estate prices there just, it is still in the boonies. It hasn't been good. So New York, unfortunately, yeah, suffered the most. Chicago has also been very challenged. Okay, so you can kind of looking at these large metros, you can kind of see which ones are not doing good, right? So Dallas is like probably close to like the third largest metro in the whole United States. So for it to only lose 784 is delinquent is actually pretty impressive. Okay. So after looking at the performances during downturn, what are people actually investing now, right? So you'll see that the percentage of people investing in offices, people are starting to withdraw their money out of office investments. Okay, they are pulling their money out of retail. Okay, the money in the amount of money invested in hospitality remains low, but who's getting more investments right now? So over the years, the amount of money going into multifamily, people see it as a very good investment. It's just more and more. So multifamily has been a major benefactor of this COVID. Okay, so 36% of the commercial activity is actually all going to multifamily. Industrial has definitely seen a pickup, especially with this year's the logjam of ships coming in, right? So industrial and storages and industrial parks are also seeing a lot more investments. Okay. Quick question. So if everybody's moving toward multifamily, do you think there's an opportunity to buy other assets cheap? Yes, I think so. In fact, for a period of time, we were actually looking to see if it is possible to pick up hotels cheap, right? Or, however, there's a reason why they're cheap, right? So because I think this downturn also exposes some of the risk associated with this type of investments. So they're cheap for a reason, if you will, right? Like right now, you see people pulling out of offices. Do you really want to go and invest in an office? Well, looking at this current trend of people working remotely, yeah, just because it's cheap doesn't mean that it's a good bet now, right? People are exiting like crazy, because what if the long-term trend is more work from home, right? Then that means your single family or your multifamily investment, it's a better bet if people are going to stay inside their residence a longer time, right? So that doesn't necessarily mean that cheaper is a better bet. You have to evaluate that against, do you think it might come back, right? Retail is always an up and down thing, right? So I get nervous when I invest in retail because what if we've been on a bull run for so long that what if there's a real economic downturn? Then retail will really suffer, right? Same thing with hospitality. But for hospitality, for hotels, I actually feel that there's pent-up demand to travel. I mean, you're going to see it this Thanksgiving, you're going to see it next year. People want to travel. People have been cooped up too long. And I fully believe that hospitality will return to more normal and a pretty profitable space. So out of all these, I wouldn't look at offices because of long-term trend. Retail is always kind of iffy for me. Hospitality, maybe, okay, if it's in the right area and I learn how to manage a hospitality. Right now, it's not something I'm focused on. But yeah, if there's still cheap stuff here, gauge where you think the long term is, and maybe if there are good deals, it's worth picking up. So in every bloodbath, there are opportunities, right? So yeah, what I was alluding more to is I don't think the long-term trend of the demand for multifamily will change. Just like salaries, right? It tends to be sticky. The demand for multifamily, we already don't have enough housing for people. So the demand for housing is just, that's not gonna be less. Okay, and we're not building nearly enough to fill the new people. So so looking at, in terms of like the trend, where are most of the transactions happening? Where are the activities, right? So you'll see that out of this chart, Dallas and Fort Worth, okay, is having tremendous amount of, probably the highest in the whole United States, right? A lot of transactions going on in Dallas, Fort Worth. Austin may not look like a large number, but remember, Austin is tiny compared to Dallas and Fort Worth, okay? Houston is really large too, and Austin has almost as much transactions as Houston. So yeah, that's pretty impressive. So Texas is, really on fire, right? Phoenix has also been extremely hot in terms of like the housing market. Okay. Las Vegas has been doing well the past year or two, although it tends to be a very seasonal market. I mean, seasonal as in the sense that when the economy is good, it is good. When it's bad, it's really bad. Okay. Seattle, also a lot of transactions. New York, a lot of transactions, trading hands. Atlanta, Georgia is another hot housing market. Okay. Orlando has been doing really well. That's a place worth looking at. Florida in general has been, pretty hot and giving pretty good returns as well. So looking at all these, it's actually very surprising that there's little very action going on in San Francisco. Okay, much less than even say Austin or something like that. It's just been really cool. Okay, right now, what's hot is Dallas, Phoenix, Atlanta, Florida. Okay, yeah. Okay, moving on to, I think one of my investment criteria is I want to invest in a place where the population and employment is growing. That's extremely important to me. Okay. Because only when you have a lot more people trying to fit in the same amount of area would the housing price jump. Would your rent prices go up because people can't find places to rent, right? So I always want to invest in a place that's growing. Okay, so you can see here, Orlando's kicking ass. There's a ton of, so we're starting to see a lot of baby boomers and other people who are starting to retire, especially during COVID. A lot of people just decide to retire early. So the East Coast people, they like to move down into Florida, Orlando area, right? So also more jobs there. So yeah, 4% growth year over year. That's great. Dallas is doing pretty strong at about 3%. It's been holding at about 3% employment and population growth over like as long as I've been investing, right? So I would say the past 6-7 years, it's been holding at 3% growth a year, right? That more or less translates to like 100,000 people per year moving to Dallas Fort Worth, or that's the size of a new San Mateo every year. So yeah, Seattle seeing really good population growth. Salt Lake City is great, but Salt Lake City is pricey. Okay, Phoenix is hot. but Phoenix is super expensive right now. You know, I would say that average price for Class B is probably 150 to $160,000 in Dallas. Phoenix is probably 20 to 30% higher than that. I mean, I've seen deals go for like 230, 240 a door in Phoenix, right? It's crazy. Houston's good, etc. Right? So you start to see people coming back into San Francisco in terms of employment, but we lost a lot of people. I mean, California lost a lot of people to places like Texas and Florida during the COVID times. Okay, Austin 2% growth, Vegas 2%. So yeah. Okay. And this chart basically, is a mapping. It helps you to see what are good cities, what are good metros to invest in, right? In terms of like, the population growth, like Orlando's really kicking ass, right? In terms of like the raw number of people, so the more raw number of people that moves in, the further right they are. So yeah, Dallas Fort Worth, Texas is really getting a lot of people, right? So you want to see possible, basically positive employment and also a large number of people moving in, right? So you also see Salt Lake City, Phoenix, etc., right? San Luis. So good indications of like good places to invest. I mean, if you invest in a place that's growing at the right price, any of these cities, you really can't go wrong. Just don't invest in places that's actually contracting, that's losing people, right? Or losing jobs. Because if people lose jobs or there's lower employment there, how are they gonna afford your higher rent, right? It just wouldn't make sense. Okay. So as mentioned, cap rate, is a rough indication of what kind of return you can get out of your investment, right? So cap rates, were the highest during the 09, 010 crisis, but cap rates tend to move slowly. So it's not like the housing market that just shoots up and then goes down and up and then go down. Cap rate trends move much more mildly, okay? But as you can see, this is for the multifamily cap rate trend, right? But as you can see, the lower the cap rate, the more expensive the prices are, okay? So with the stability, with the demand for multifamily, the cap rates has just been trending down, okay? So now the national average is about 4.6%, okay? So it means that, yeah, it is getting more expensive. And, the question is, are we gonna see cap rates go back up, right? Are we going to see that? Are we going to see that? Do we hit the peak pricing? Okay, is it going to start going down? All that kind of stuff. So keep this in mind. I'll revisit this again once we cover a little bit more topic. Okay. So this is looking at basically last year versus this year and seeing how much the cap rates have actually dropped compared to just 1 year ago, right? Remember, any drop in cap rate means prices per door has basically gotten more expensive, okay? The expected returns are just getting a little bit less, right? Because more people are fighting for the same product. So San Francisco has always been historically low already. If you look at like the top circles are basically where they were last year, and blue circles are where they are now, right? San Francisco is very expensive right now. It's only at a 2.8 cap, right? New York still expensive, just for the land location, right? So something interesting, you'll see that, yeah, so Austin compared to a year ago also gotten a lot more expensive, right? But it's justified because there's just so much businesses moving to Austin. Tesla is building a big gigafactory. It's going to build rockets there. It's going to build battery facilities there. It's going to build Cybertruck. He's moving his neuroscience, Neuralink there. There's just going to be tons of job opportunities, and Austin will grow. So, and hence the prices for the units there is reflecting accordingly. Okay. So yeah, Dallas has also seen a drop, the cap rates tightening, right? Not as bad as others, but we are seeing it. Nashville got very expensive, interestingly. Okay, but in general, you can see compared to last year, the cap rates have dropped on probably average of like 0.4, 40 basis points or 50 basis points. So there's a lot more demand, right? Okay. So what does this mean for multifamily? What we can see is, so each color represents one quarter: Q1, Q2, Q3, Q4. Okay. So 2020 was definitely a down year for multifamily. There were a lot of transactions that were in the middle of being purchased that just basically didn't go through, right? So 2020 actually started out looking like it was going to be one of the best year ever for multifamily. And then March hit, COVID hit, and all the activities just died down. Okay, just completely stopped. Okay. I mean, we were bidding on a 550 unit portfolio last year, and we were about to go under contract for that, but we backed out because of COVID, right? I mean, with that much uncertainty, we didn't want to buy the deal. But then what we saw was activity started to pick back up towards the second half of 2020. So after people realized that, hey, COVID isn't terrible, the economy didn't go to crap, and it's actually recovering, people see how well multifamily did, and then they started reinvesting. Okay, so you can see that in 2021 also the volume was really high. Through the first 3 quarters of this year, we are already exceeding the entirety of 2020, and once this year closes out, we are likely to have the most active multifamily transaction of the whole year, of all time, actually. Yeah. And I'll explain a little bit about why that is. Because basically, in 2020, when COVID hit, these large private equity, like BlackRock, like Greystone, for example, they saw opportunity. They're expecting prices to drop, right? They're looking for a fire sale. They're thinking that they're going to be able to pick up a lot of properties for cheap. So they went out, like I think BlackRock raised a $5 billion fund, okay, getting ready to pick up things on the cheap. It didn't happen. Okay. It didn't happen, and so they're sitting on $5 billion worth of commitments and funds, and not being deployed, right? So they ended up having to use them. It's basically use it or lose it, right? The investors want their returns. So they started to buy anything they could get their hands on. That carried out through the whole year of 2021. These private equities, these real estate funds, these even family offices. So they have all these capital they want to deploy. Okay, so they were overbidding on apartments. They were overbidding on any opportunities that they can get their hands on. Okay, at the same time, you have people moving in from other industries, right? Remember, people moving in from hotels, people moving in from retail or offices, right? They all want to invest in this space. Okay. And that's what has driven so much volume that we're seeing this year. Okay. Where people are really just bidding because they're large institutional owners. They want to hold these assets for like 5 years, 10 years, or even longer, right? If it's cash flowing, if it's a stable product, yeah, they want to buy it. And which is why you see this general trend of the cap rates is slowly compressing. Okay, compressing, we mean getting lower, right? And the prices per unit has been trending up. Okay, so you can see it's gone over the there was a bit of a dip during COVID, but now it's definitely recovering. And I wouldn't be surprised if general trend is, especially with the current demand, it's just gonna keep going. Okay. So, of course, you can't just be buying, for the heck of it, right? But the price has to be justified, right? So why are so many people jumping into multifamily, and why is it still such a good investment? It really comes down to rent. If you kind of look at the rent levels across the nation, right? It's been fairly flat. Maybe you'll see like 2% rent growth, 3% rent growth through the whole United States, but this year it's been incredible in terms of like the rent growth that we have been seeing. Okay, this report is from Yardi. Yardi basically provides accounting services for apartments, right? So they get first-hand data on how the rents are trending. And we see this in our properties. We literally raised 10% rent compared to last year, and we're getting no pushback. Okay. I mean, some properties have raised it like almost 20% compared to a year ago, and they're still 98% occupied, right? There's such a demand for housing, especially for rentals, that is just driving the rental rates crazy, and people are paying it with their inflated salaries. They are affording, they are able to keep up with this rent, right? Another trend that we're seeing is for the younger generation, like people in their 20s, early 30s. They like mobility. They don't want to be tied down by a house. They like to travel to different places, right? And be able to explore different opportunities. So for example, good friends of mine, right now, they're not thinking about buying a home. They're thinking of, I'm gonna move to New York, go live there for 6 months. All my friends are there. We're gonna explore the city and enjoy our young life. And then we're gonna move over to Seattle. Okay, live 6 months there. Since we can remotely work, why not take this opportunity to explore? And then after that, we'll move to Vancouver, right? So the younger generation's mindset is very different than like oldies like us, right? We want to buy a house, settle down, and stay fixed in one place. The younger generation wants to travel, wants to change environments, right? And they don't want to settle down so quickly. It's really not until like they're ready to build a family do they then look at a place to settle down. So what this means is that the younger generation that has much higher earning potential like renting. And this has also attributed to this rise in rent because some of the people that used to buy, well, either they can't afford the new housing prices now, or they're just choosing to rent. So, okay. And this is basically, what did the rent growth look like? So you can see that it's been pretty stable at about 3% over, the last 10 years. It's been a really stable run. Okay. In the 2020s, basically nobody raised rent. So this is not a drop in rent. This is just the rent growth flattening out to about 0%. Okay. And then this year, it's just crazy. Yeah, I think this is still a little behind, but right now it's looking like a 7 to 8% rent growth across the nation. It's just really, really strong. Any questions so far? Okay. So I get asked this question a lot, right? So Tony, with the cap rates getting lower and lower, is it going to go back up? I mean, is it, with the pricing so high, is this a good time to buy? If with the pricing higher than where it was a year ago, when, is it going to go down later? And that's directly tied to the cap rate, right? Cap rate basically represents how expensive something is, right? So the thing I had to say is like, you know what, I've been investing in multifamily a long time. Every year we thought that, oh man, it's been going up. It cannot, how much higher can it go? And every year we think that we're near the top, and every year we're proven wrong and wrong and wrong again. Okay. Now, in terms of like where we are now, okay. So then I kind of look at, then for me to evaluate where we're gonna go is like, I look at, well, the things that affect pricing and cap rate, right? So what are things that will affect it? Okay. Well, investor interest. Okay. How much supply and demand are there, right? Is it a good hedge? Is multifamily a good hedge against inflation? Okay. Is the interest rate low, right? Is the rent growing, right? So, and right now, it's checking every single box. And in terms of what I can see next year and probably beyond, I don't see the investor interest in multifamily asset is slowing down at all. More and more funds are actually going into multifamily. People realize it's a good investment, right? In terms of like supply, right now, there is more demand for housing than that can be built. And remember, in year 2020, builders stopped building. Okay, so we already were not building enough, and now we're actually in a deficit. We're in a hole. There's a whole year, a half year or more of, not supplying more units, right? And that was also because of the wood prices. So for almost a year, the construction slowed down dramatically, and now we have even less supply to meet all these demand. Yeah, and with inflation going up, people are going to continue to buy real estate, right? Multifamily. Interest rate, like I said, it may be ticking up, but historically it's so low, right? And with the rent growth growing so crazy, I really don't see the cap rates getting higher. I really don't see in, at least for the next year or so, or probably a little bit beyond that, of the pricing coming down at all. So yeah, looking at all the factors that will affect it, right now it's yeah, everything's firing on all engines. Doesn't rent growth make the cap rate go up? So if a cap rate go up, that means the price per unit is actually getting cheaper. Okay, so if the rent is going up, it actually means that a property is more profitable. The property is making more income on on the assets. So with it being a more valuable asset, the cap rate will be dropping. Okay, so it is going to be more expensive because it's a more profitable business that you're acquiring. Okay. I hope that kind of explains like, what the current market looks like. Why we think that we're seeing this rise, in demand for multifamily. And, probably another good thing to also kind of explore is industrial, right? Industrial is like that because there's literally no supply. There's For building a brand new industrial, you need a lot of land. okay, and you need permits and all that kind of stuff. And this is not something that just happens overnight. And we just don't have enough. So right now the supply is really tight for industrial. Even if we try to go and buy some industrial, it's not easy. Yeah, and the prices are also going through the roof. But from what I can see on the real estate side, from multifamily side, I only see this trend, that this demand for buying this as an investment as well as a place to live. I think this trend will continue. So for example, if we take a look at Dallas, right? So it used to be San Francisco was like a 3 cap, okay, very expensive. Dallas was like a 5 cap, okay, and Austin was like a 6 cap, meaning it was still relatively cheap. But with a population and job dynamic now shifting to these regions, right? You're not gonna get the little sleepy town that Dallas was 20 years ago. That's not the case anymore. It has fundamentally changed into a much stronger economy. It has fundamentally changed to a stronger population, right? So it's never going to go back to that, the really cheap cap rates anymore. It is now a major force, right? It is now a major, that's where the future developments are going to be. So it will never go back to the old pricing, because now Austin and Dallas is really like a San Francisco, right? And it will be priced accordingly. So yeah, I don't see it going back. I actually see it holding pretty steady at where we are. So yeah. Do you have any tips on how to identify the next Dallas? Isn't that the $1 million question? So I think for me, I will look at, so for example, like when we looked at Indiana, when we look at Kentucky and all these kind of stuff, we're basically looking for places that have good population growth, that has a diverse economy, okay, that is on the upswing, okay. It hasn't fully been there. It hasn't fully, been kind of the super established 10-year run of growth, right? But we can see that it is starting to grow. Jobs are actually starting to come in. Those, jobs and population growth is still going to be my main metrics. Okay, I wouldn't take a risk on some places like Louisiana that's giving you a 10 cap, right? But that's because the risk that you take in that market is so huge. Okay. So I would still look at Midwest. Midwest is doing really well. Midwest doing really well, and look for places that has positive growth. Yeah. And so, I mean, a lot of these places, they're also growing. Then for those major markets, then maybe you want to look at some of the secondary markets or tertiary markets next to it, right? So, for Dallas, for example, or Austin, instead of buying right in the city center, okay, think of investing in places that's maybe like 20 minutes away, 30 minutes away, okay? That is, a secondary market, right? It's close, but it's about a 30-minute commute, okay? But what we see is when the main metro is growing so fast, it spills over to the neighboring cities. And those are up and coming investments as well, right? So tertiary market, secondary markets are all, fairly good bets as well. Okay. What would be your recommended best way to enter multifamily? Invest with syndication or buy your own? So the way I did it is I invested with syndications first. Okay, so I invest in other people's syndication. This builds experience. This also builds credibility so that when I go out and buy my own syndication, I can show on my resume that I have been investing in commercial real estate. Because if you don't have any experience there, people won't trust you to buy a multifamily asset, a large multifamily asset, right? And a very good advice I got from my friends is try not to do small multifamilies. Very high chance of failures. It's much harder to manage because you can't afford a good property management company that knows what they're doing. So the recommendation is gain your experience by investing in syndications and learn what they do, build up your network of people, okay, that you can bounce ideas off of, right? And you can get help from, help you review whether your purchase is good or not, okay? And build up your network of people you're gonna be buying properties from, okay? So, and mainly to get experience. And then once you have enough experience, then you're more able to go acquire properties on your own without the risk of losing all your money, trying to, do it all by yourself in the beginning. Yeah. How would you interview syndications? I may actually have a past video on that where I cover that topic. I'm a big time passive investor as well. Like I said, I've invested in 12 different syndication deals passively. So I have certain criteria that I judge a syndications by. And a lot of that comes with experience, right? So I looked at so many deals that I know what are some of the where people tend to exaggerate returns, okay? When they kind of overpromise what can be delivered, right? So the things that I kind of look for in syndicators is first, I want to know if they have money, okay? I mentioned this before, I know it sucks, right? But I usually want to invest with syndicators that already have money because those people want to protect their reputation, okay? Versus some guy who just started out and, he's putting down all the, some money that he has, but if it doesn't work out, he's just gonna bail, right? He's not really thinking of doing it long-term. So I like people who has money. If something's not going well and needed, they will use their own money to make sure the deal survives and can keep going. Okay. And people with money can usually, handle emergencies better. They have friends that can bail them out. And they have they have a lot of other investments in their life. So they usually know how to manage the money investments better. So I like people who already have money. The other one is see if they're promising some crazy returns, right? Like I said, right now, the average multifamily project realistically right now will probably return you somewhere 12 to 15%, okay? If you see people going like, you can get 18% return, you can get 20% return, or even 25% returns, right? They're blowing smoke. And those are the people I will be very careful about because they're very aggressively trying to recruit new investors by using very attractive numbers, but those are not real numbers. So what I learned is I try to stick to people who is providing real numbers instead of inflated numbers. Because those people who already have a loyal following, they don't need to exaggerate their numbers to attract new investors. They can just, so for example, like me, I can tell my group of investors saying that, yep, I think this deal, I'm very confident that we will be able to do a 12% return, okay, or 13% return. I'm sure I can achieve much better than that, but I will only say that, yep, I think 12%, it's achievable. And everybody knows that they can trust that number, right? Otherwise, the same deal, somebody can spin it like, oh, you can get 18 to 20% return. But that's if everything is done to perfection and the market doesn't have any kind of hiccup. Wood prices doesn't go up. Contractors don't give you problems, right? So I'd rather, but they don't have as many investors, so they have to overpromise. So I'm in a lucky position of people, of having a good group of people who trust me, so I don't have to, overstate what can be delivered, and they will still invest with me. So I like to look for conservative people. I like to look for people who has money, and I also like to try to see if they have any successful projects before, right? So if they already done like multiple deals and they had a very successful sale already, that shows me that they know what they're doing, and they actually had a deal that went the full cycle, right? So that gives me a lot of confidence. Okay. Is there a Yelp for syndicators? That's a great idea, actually. but no, unfortunately, there isn't. One thing I tried to do with this meetup was actually to be a Yelp for syndicators. So in the beginning, when I was actually buying deals, we were meeting in the Milpitas library. It was like just 5 to 10 of us. We were literally just talking about like, hey, what deals are out there? Which syndicators are out there? Have you invested with them? Well, what's their reputation? And that's all we did. We just constantly try to get more information on like, hey, I saw this deal. I don't know the syndicators. What have you heard about them, right? And I think, I want this group to also continue to do that. It's not good to talk about it in our recorded session, but when we have in-person meetups, that's a lot of times that's what we do, right? It's like, hey, hey, XYZ has a deal. What do you think? Is that real? And then all that kind of stuff. So references from people who have invested with those people is great. There's no official Yelp, but you'll find a lot of chances to find people who have done investments in meetups and just, on these regional meetups, and just chat with them and see what their experiences are. Okay. It sounds like you like large multifamily versus small multifamily. Do you still recommend small multifamily over single families? Yeah, I mean, I do, depending on how small the multifamily is. So anything like 20 units or 30 units, look, you're not going to trust a property management company. They're not very good quality at that level. You're going to be running it, okay? So it's going to be a full-time job. Do you want to do it? Okay, you are going to get some benefit of scale, right? It is just one property to manage also, as opposed to like having to do tax and paperwork and call plumbers for like 20 different single family homes. You have one 20 unit property, right? So yeah, it will be easier, and there will be a lot more benefit. But yeah, it will be a lot of work, right? And maybe that is a school of hard knocks that you have to go through, right? But and that will probably teach you a lot in the process. But in my opinion, I think that's more pain than you need to. I went from one single family, and the next one I bought was 146 units of multifamily. I skipped everything in between, right? I probably saved myself 5 to 7 years worth of going from 20, from 4 to 20 to 50 to 70, and then I skipped all that by passively investing in syndications, learning, and then partnering with people who have experience and jumping straight into the large ones. Because trust me, managing 100+ units is a lot easier than managing 20 units. Yeah. Cool. Keep going. So I'll kind of wrap this up by where are loans right now. Okay, if you want to because I think the landscape has kind of changed over the years. So it used to be that Fannie Mae and Freddie Mac, we get loans directly from them. They give us $20 million, $30 million loans, and they would say 3.2% rate, right? Here you go, $30 million. And I'm only going to charge you 3.2% rate. And it is non-recourse, meaning that they can't come after me if the pricing drops below the loan amount. Okay. So they were the Cadillac of loans, right? But the main thing is Fannie Mae and Freddie Mac look at past performance to determine how much money they will loan you. So that means they look at the past 12 months of this apartment to see, based on the historical numbers, I'm willing to lend you this much money. Okay. However, as we all know, the past 12 months was COVID. It was terrible. Nobody was raising rent. So the past 12 months of numbers are not going to look great. Okay. So they're willing to loan up to 80%. But lately, what the kind of quotes we're getting is they're willing to loan only up to 60 or 65% based on historical numbers, right? Whereas right now, 90% of the loans are actually probably non-recourse bridge. Okay, so basically 3 to 5 years of a loan, after which you will either sell the property or refinance into a traditional Fannie Mae or Freddie Mac loan. Okay, so the non-recourse bridge, their difference is they're looking at the future. Okay, so they're looking at the current rent trend, where are you going to be in the next 2 to 3 years? Okay, and then they will make a loan based on how much profit there may be in the future. So because they're looking forward, and right now the rents are going up like crazy, the prices, the cap rates are, on the trend of, going up, right? So they're willing to loan more money. So non-recourse bridge is more optimistic. They're willing to loan up to 75, sometimes up to 85% loan to value, right? So it used to be, for the past 5 years, actually past 10 years, everybody was trying to get a Fannie Mae loan or Freddie Mac. Now they're doing almost no business. Everything is non-recourse bridge right now. So it used to be that the bridge lenders, there's only like 3 to 4 back in the day, and they would charge rates of like 7 or 8%, right? But over the past year or so, they kind of realized that, hey, multifamily is a safe bet. It didn't die in COVID, right? That means that the risk of, borrowing money to multifamily is safer. So they started to loan, right? And then more and more banks started to do this non-recourse bridge. And now there's like 12 to 20 bridge lenders, and they're all kind of competing each other for price. So instead of 7% interest rate, we're now seeing maybe like 3.5% to 4% interest rate. Okay, and that makes it very competitive, right? Another big difference is Fannie Mae loans tend to have a prepayment penalty, okay, which could be very big, right? Which could literally be, the penalty could be 30% or 25% of your loan amount if you prepay within the first few years. Okay, that's huge. That's gonna kill your whole return, right? Whereas non-recourse bridge only charges you 1%. So that's why there's such a shift away from Fannie Mae and Freddie Mac agency loans into products like a non-recourse bridge. Okay. But right now, Fannie and Freddie, looking at the next year's budget that they have, they're federal managed entities, right? And the federal government kind of determines how much you're allowed to loan next year. And next year, they got a pretty good budget, higher than what they're able to loan out this year. So we do expect that next year, with more money on hand, they will be able to loosen up their lending requirements and be more willing to do deals because they didn't do that much this year. Okay. So out of these four, if you're buying like a small 20 unit or 40 unit, 30 unit type of deal, when you're buying small, you're probably getting a bank loan most of the time. And guess what? It's full recourse. So if you borrow $1 million for a $1.5 million property, and that property later on only the value drops down to $800,000, guess what? You're on the hook for 200 grand. You are responsible for making up that difference. Okay. So when you're dealing small, right, all your options are not as good. Your loan is not going to be as good. Your property management company is not going to be as good. The rate you're going to get on your loan is not going to be as good. The bigger you go, really, the cheaper it is, right? So on a 100-unit multifamily, if you get a Fannie Mae loan, it's probably like a 3.2%. If you now try to get a loan on a 400-unit property, that is probably going to drop it down to like a 2.7%, right? So in this business, it's all about scale. The bigger you are, the more profitable you actually become. Hope that makes sense. So, yeah. And then, I won't go into it too much detail, but this is the rough shakedown of where the loans are. Next time, I'll really go and compare the differences between them, and maybe give you some sample. So this is actually from my his name is James Ng, and he's also a partner in my deals. So we have the benefit of getting insider information when it comes to loans as well. Okay, cool. Well, that's all I have. I'll open up the floor, or you guys can also send comments if you have any questions. I'm happy to answer them. Kong asks, how do we get started with zero previous experience? No problem, so I think as many of you know, I'm currently doing apartment 101 series where I pretty much try to teach you guys how to invest, from beginning to end, like how to get into multifamily. Yeah. The best way is to invest in syndications, gain the experience, see how people do things, and then you're able to build that up and be able to do it yourself. But feel free to watch my replays where I did like a multifamily 101 on the basics, multifamily 102, I think it's on like the buy and sell cycle. Multifamily 103 was, I forgot what it was. But I think it was like how to actually make projections, how to underwrite a deal, right? And then I'll go through like, I think in total we'll have like a 106 to 107 to talk about all the different aspects. So yeah, feel free to watch that. Hopefully that will help you. But to gain real experience, I would say, yeah, invest in a syndication. And when you start out, you may want to invest your own money on some deals. And yeah, syndication is usually the best way to scale up to a much larger property, right? So it says, can you share your loan officer contact? Sure. You feel free to just contact Old Capital Lending. Okay, so they're a national lender broker that's located in Texas. very knowledgeable. They have helped me out on different loans, and they can do bank, they can do bridge, they can do Fannie Mae, Freddie Mac, you name it, right? So they'll be able to pick the best product that matches. Yeah. And feel free to reach out to me through Facebook or Meetup messages. I'm happy to do like a short chat and yeah, see how I can help. Am I working on a deal or deals? Yes. Yeah, I am. I mean, we just put in the offer today actually on the deal. So if we do get it, it won't be a public announcement because we only announce it to the people that's on our email list who wants to hear about the deals. So yeah, please do sign up for the newsletter. This way you'll be notified when we do have a deal available. I'll post it again. So this way, and then once when we do land a deal that's good for everybody, we will also have a private meetup to share the details, share the business plan and everything. Okay, so yeah, please join that newsletter, and yeah, we'll keep in touch. Is there a skill set that will be useful to experienced indicator? A way for a newbie to add value? Yes, there's always things to help. So for syndicators who have been doing a few things, there's always things that you can help them with to add value and also learn along the way, right? So for example, I'm not very good at designing websites and those kind of stuff. I'm not very good at marketing. So if there are people that can help me with just putting up a website, helping to, I don't have an Instagram account. Like I know all of you people do and have Instagram accounts and get tons of people to talk to you just through Instagram. I don't do that. I'm so old sometimes. I feel so old, but but in terms of like these things, right? You can help somebody build that kind of social media presence, or this kind of stuff out, right? That he may be too busy to not have time for. Also, I look on average of maybe 10 to 15 deals a month, all right? After I have filtered out most of the stuff that I'm not interested in. And then it takes time to also underwrite the deal to see if it is worth going after, right? Worth investigating. So that takes time, but I think that's something that people can help with and also learn along the way on how to evaluate deals. Okay, so that's something else that can be helped. Yeah, and in general, if you have a big group of people, many syndicators actually are looking for people that can help bring in funds, to invest with them. So that's another way that you can bring value, right? So many things you can do to add value, right? So, but usually that starts with like just chatting with a guy, getting to know them and see if it's a good match, right? So yeah. Anastasia said, yeah, interested in getting a group. Yeah, I would say, yeah, please just join the newsletter. And then generally the investors, when they get notified there's a deal, they evaluate for themselves, looking at the business plan, looking at the location, looking at the property, and you decide on each deal whether or not this is something that you want to go for. It's not like you're just committed to it, right? So like me, I get like 5 to 6 different offers a month, and then for me it's very quick, like, okay, I know this deal is just, no, it's in the middle of nowhere, they're promising crazy returns, but no, that's not something that I would do. Yeah. Do you have opportunity zone deals coming? What is your feedback about opportunity zones? So I personally haven't invested in opportunity zones. I'm familiar with them. The thing is, with opportunity zones, there's a lot of tax advantages, right? So cities usually will offer tax advantages to like a neighborhood that's not good. Okay, so they want to encourage people to develop there, then they'll offer tax credits. They'll mark that as an opportunity zone and offer that as a tax credit, right? So not the greatest for you to build a multifamily or condos around, but what I found that has been pretty successful is people build data centers there. Okay, it's an opportunity zone. It creates jobs, right? And you build a data center that's basically fully self-enclosed. It doesn't really matter what the neighborhood is. You just want a cheap land, right? And tax discounts. So data centers actually work really great in a bad part of town. so I've seen those deals, and that's something I would consider. Yeah. So Christian says, I'm confused on how to think about cap rates. It is one of the most confusing things. Okay. So cap rate is NOI divided by property value. Yes. Okay. So last year had lower rents due to COVID. Isn't the cap rates are lower because property is? So it is. So cap rates went up briefly last year during the beginning of COVID, but then it dropped. Okay, so it got more expensive because the rent really didn't drop that much. Okay, so for example, at the beginning of COVID, I thought the rents were gonna, my collection, I was projecting the worst case, which is I was thinking that, okay, what if my collection drops 40%? Okay, am I gonna be able to survive? Turns out, based on my calculation, I can survive for a year and a half, right? But I was bracing for a really bad scenario, like 40% rent drop. That didn't happen, right? The rents were actually, I think on average across the United States, occupancy stayed above 90%, and collection stayed above 90%, right? There was barely, I mean, maybe there was like a 4 to 5% drop. It wasn't that bad at all. So that's why the cap rate didn't get worse. It actually got a lot more expensive, right? So will cap rates normalize next year? Well, let me put it this way. If the rent, so yes, if the price doesn't move and your income is growing, then yes, your cap rate will be better, right? However, there's a lot of demand to buy multifamily. So if the buyers see that your rent is going up, they're gonna charge, they're gonna be willing to pay a higher price for that property. So yes, your rent is going up, that cap rate will look better, but the purchase price is going up as well, right? So that would bring the cap rate back down. So yeah. Question: How can I learn to value deals? You'll want to look at apartment 103 that we did 2 weeks ago. So there's a replay available for that. I'll just type that in right here. bit.ly/apt103 replay. Okay, so oops, let me type that to a general everybody. bit.ly apt103 replay. So if you can go take a look at that replay where I talk about how I underwrite deals. Just type this just in case it was sent as private. Yeah. Yeah, so and then you can just change it to 102 replay or 101 replay if you want to watch through those. So you should be able to learn a lot from that. Okay, question: how much is usually expected when starting out in terms of minimum fund and investments with syndications? Typically, it ranges from $50,000 to $100,000 as minimum investments. So, depending on the syndication, yeah, if they have a lot of investors already, they're not hurting for cash. They might ask for 100 grand so that there's less investors to have to manage. But there's also, many syndications offer investments as a $50,000 minimum. Okay. If you have an IRA, you can also change your retirement account to be one that is called a self-directed IRA. Okay. And with a self-directed IRA, you can invest in more than just stocks. You can also invest in syndications. You can also invest in startups as an angel investor, as a VC, basically. You can invest in, much more things than just stocks. So that's what I did. That's how I'm able to make some of my investments. I invested using my retirement funds, and I'm getting better return than other places. So I think it's a good thing. If you need to know how to do that, contact me. I can refer you to the person that I use to set up my self-directed 401k. I mean, self-directed IRA. So yeah, just shoot me a message, and then I can do that. Okay. Anybody else have any other questions? Feel free to unmute your mic also if you just want to chat and have questions. Okay. Well, if not, then thanks everybody for joining. Yeah, and feel free to reach out, but hope everybody have a happy Thanksgiving and a happy holidays.
All right. Thanks a lot, Tony. It was very useful. Happy Thanksgiving to you and family as well.
Definitely.
Appreciate it.
Okay.
Appreciate it. Bye-bye.